So in 2022, the stock market had a crash of nearly 20% down, and Goldman Sachs thinks we could be headed for a 2008-like crash in the real estate market. So I put together data from the biggest real estate institutions in America and what their predictions are for 2023. And this includes companies like Redfin, Realtor, and Zillow, and all of their data they have provided for their 2023 real estate market projection. See, I think it's best to look at these companies for insight up to what's coming in the future. They have big teams, a bunch of tools that we don't have access to, but I can also give you my opinion towards the end of the video. But I do have my degree in finance, so welcome to Austin Means Business. We're going to be covering the good, the bad, and the ugly for the 2023 real estate projections. During 2022, real estate market was crazy. People were buying homes left and right, and the prices increased by so much. From 2020 to 2022, the real estate market had increased by 40% for medium home sales, which is nearly a decade's worth of price appreciation in 2 years. And now, obviously, that's not sustainable, and what goes up must come down. But it's important to know that this is different than the 2008 real estate crash. In 2008, there was a bunch of subprime mortgages going out, meaning people were getting mortgages that they shouldn't or that they can't even afford. And this means thousands of people defaulted on their loans and hundreds of thousands of houses entered the real estate market, making prices drop very suddenly. And this is what we know as the 2008 real estate crisis. But that's not happening this time. People aren't getting loans they can't afford. There's been new laws and regulations against that. But what I want to say is, like in 2008, no one really predicted that. So I want you to take these predictions from these companies with a grain of salt, because if they couldn't predict a crash in 2008, that doesn't mean they can predict what's going to happen next now. We're going to be starting with bearish forecasts and working our way towards the end of the video towards the most bullish forecast. And we're starting out with the Goldman Sachs. They're a leader in investment banking. And they recently sent ripples to the whole real estate market because they put out an article saying that 4 cities could see a 2008-like crash. And those cities include San Jose, Austin, Phoenix, San Diego, while places like Miami and Baltimore will actually increase this year. In Investor Place's article, they say Goldman Sachs argues that some cities became too detached from the fundamentals that was amid the housing boom during the pandemic. And Goldman Sachs thinks those 4 cities, San Jose, Austin, Phoenix, and San Diego, are set for at least a 25% correction from their all-time high. And a crash is considered 20%, so they're already 5% they're predicting bigger than just a regular crash. But some areas have already fallen by 10%, but investors are not happy with what Goldman Sachs has said. Local experts call their report hyperbolic and misleading and a disservice, according to Axios. They say it's to inspire panic and it might promote a crash, an artificial crash that wasn't really warranted. But I don't really think that's too far out of the realm of possibility, as we see Phoenix, they have increased by already 60% since the start of the pandemic, which is in the range of increases from cities like San Francisco at 69%, Las Vegas at 58.9%, and 52.4% being Miami. But just by looking at these huge increases, it makes you think that this obviously can't keep up, this isn't sustainable, and a crash would set prices back to normal or what considered reality. But outside of specific markets, Goldman Sachs expects nationwide real estate declines, highlighted in light blue, to begin around Q2 and throughout all of 2024, meaning that they don't think the real estate market might not be a quick fix and it might take over a year to correct and get back to reality, even citing that some of 2024 will still be impacted. An interesting article from Goldman says, this path would cause affordability to worsen incrementally after a slight improvement over the past 2 months, the team said, with home prices likely to fall 1% appreciation in 2024 if the U.S. economy avoids a recession. Meaning that Goldman thinks that we're going to be headed down for the year, and it's going to be a red year, especially in those high growth areas. But if we can avoid a recession this year in 2023, I'm looking at you, Powell, they can expect to see real estate prices turn around as soon as Q1 of 2024 and increasing about 1% in 2024. As far as the big banks and big firms, Goldman Sachs does have the most bearish outlook at negative 5% for the overall market, with even some forecasts as being as negative as negative 15%. That was a lot of negatives. Another company that thinks we are going to go down is Redfin. Redfin is an MLS. They have a browser feature. They have a website. They are a great source for data because they see so many different transactions every year, and they can build reports and surveys based on that. I'm sure you've been on their website once or twice looking at homes in your area. In their monthly market report, they look at the top 90 metropolitan areas with greater than 750,000 or people more saying that's going to be impacted most by the overall economy. The home sales rose in a couple places, but declined by 77% in Boise and 65% in Baton Rouge. But what I think most is interesting is their listing and supply numbers have changed. Boise is down 57%, Greensboro down 52.2%, Tacoma down 48%, and Seattle down 48.2%. And then on the supply side of things, Greensboro, Milwaukee, and Hartford fell by at least 28%. All of this bringing Redfin's overall projections for the 2023 year real estate market between +5 all the way down to -15%. And as Redfin describes the variability in the market depending on location. Some high metropolitan areas will be seeing price hits quite drastically, while other places might see small increases. Now, their overall projection in their official statement is 4% for the year of 2023, falling by roughly 2% from a year earlier, making the first year-over-year drop since 2012. Home sale prices will likely fall by 5% year-over-year in the second and third quarters, then ease to about 3% drop by the end of the year as lower rates bring back buyers to the market. And overall, I tend to agree with Redfin. I mean, if you consider the supply is still increasing, people are still building homes, and to think that prices can still going up while the supply is still being added, meaning there's way more houses to the market to buy, I think it's kind of insane to think prices are going to go up. So -4% is kind of the ballpark of where I'm thinking too. Now, the more extreme forecasts for the whole economy are going to come out of these two companies, and one of them is predicting a legit crash. John Burns, a real estate company, they're a consulting company. They work with builders, realtors, investors, all of the above. They're predicting a legit crash, -20% they say for 2023. Now, Zonda is a different company. They provide information to residential and commercial builders, and they are predicting that for the year of 2023, we go down by 10%. So half of what John Burns is saying, but still way higher than most of the market and most of the other firms, which these are just independent research companies. They don't really do a whole lot. So maybe it's something to consider, or at least take into account. But moving on to bullish people, meaning people who think that the market will go up or at least stay neutral but not decline. And first up, we got Zillow. Now, Zillow is a very popular MLS where I'm sure you've been on that website too. You just type in Zillow, it's probably the most popular one. But this year they're predicting a 0.08% increase. And Zillow gives us 5 reasons of why they think home prices will increase slightly. First up, they think homes are going to be more affordable. So they think home prices won't be on a wild ride with crazy fluctuations and changes every week. And they think home prices will remain relatively flat, giving buyers more confidence. And they say as inflation slows, you should see mortgage rates come down towards the end of 2023, making the end of 2023 the most affordable time to buy a home. So another interesting thing is they're predicting people will move to the Midwest because the Midwest didn't have the crazy price impacts that all the coasts and all the big cities had. And right now, home prices are much lower in the Midwest in cities like Missouri, Illinois, Kansas, Iowa. And it's an interesting take that people will start moving there due to the low prices, and investors might start looking there to invest. Another reason they think prices will remain relatively stable is they think more people will be buying houses with friends and family. A Zillow survey found that 18% of successful home buyers purchased a home with a friend that wasn't a spouse or partner. And they predict that this trend will continue, and this significantly helps with debt to income ratios, so getting approved for larger mortgages is possible doing this. And everyone says that building wealth, the best way is to buy a house, and that is true. So by using friends and family, people can buy houses at younger ages and profit off that. So another reason that Zillow gives for their price is they think new construction will remain the same and giving people better deals and better opportunities to buy. If you think that new construction has been happening every single day and they have their own jobs, so that hasn't been really slowing down, the only thing that can change is they're starting to lower their prices quite a bit. And now if the new construction price is lower, then the other homes need to lower in order to match it out. And then the last reason is more homeowners will start leveraging their house as income. In a Zillow survey from 2021, they found that 1/3 of Zillow buyers mentioned that the opportunity to rent out their home as a big reason for their purchasing decision. During the pandemic, many people took advantage of low mortgage rates and purchased a second home for the one purpose of renting out. And Zillow thinks this trend is going to continue and keep, well, their prices more of a neutral at 0.8% for this year. So next up with bullish or at least neutral forecast is the National Association of Realtors, or the NAR. And they titled their 2023 forecast for the real estate market Regain Normalcy. And they give a relatively neutral forecast. NAR chief economist Lawrence Yun said housing inventory is expected to remain tight in 2023 with housing starts below historical averages and fewer homeowners willing to sell. They expect median prices are forecasted to reach $385,800, an increase of 0.3%. Yun says after a big boom over the past 2 years, there will essentially be no change nationally. Half of the country may experience small price gains while the other half may see slight price declines. And so the NAR believes that mortgages have already peaked and they're on their way down. And mortgages drive the amount of home sales because if the rates are higher and mortgages are more expensive, then less people are willing to sell and less people are willing to buy, meaning that total home sales or the volume of transactions is much lower. So they think that this is going to kind of hit an equilibrium, kind of right in the middle, and they think that there's going to be the same amount of buyers and same amount of sellers, which is going to keep the price about the same at 0.3% increase this year. And then they also think mortgage rates are going to be around 5.7% to the end of the year. And considering mortgage rates are around 7% right now, it might be best holding off until towards the end of the year to see what the real estate market's doing. And if they think it's going to be around 5.7%, it might be best just waiting until what the Fed says and different economists say and just kind of see where interest rates go, because a lot of people are predicting it's going to be headed down. So the most green or the most bullish forecast is coming from realtor.com, and they think that we're going to increase by 5.4% on a national average. And they say mortgage rates are going to remain at 7.4%, which is kind of interesting because if the mortgage rates are higher, less people like to buy and sell, meaning that prices shouldn't change that much. Or at least you wouldn't be expecting them to go up. Typically, the higher the mortgage, usually prices come down. I mean, the whole point of increasing interest rates is to bring prices down. So it's kind of an interesting take. And they say inventory will lag behind 2019 levels and will be up from 2022 by 22.8%. And the monthly cost for financing a home for sale will be an average of $2,430 in 2023, which is nearly up 28% from the average mortgage payment for people who bought in 2022. So what do I think is going to happen with the overall real estate market? And my 2 cents, like I said, these big companies have been wrong by a lot of predictions, so maybe mine's right. And I hate to be negative, but in a way it's also positive. It depends if you're on the selling side or the buying side of this. And I'm looking at buying a home in the next couple of years. And I think this year will be red. I personally think we're going to be around 6% on a national average down, but places like the Midwest and people that are in rural areas won't see changes as big as certain areas that have seen the biggest increases. Kind of like Redfin said, I think the places with the biggest increases are going to see the biggest downfalls. So places that went up by 60% during the pandemic, they might actually hit a negative 20% downfall. I mean, we're already seeing cities that have seen 15%, so another 5% really isn't out of the realm. But I don't think we're going to see a lot of panic, even though that still might be considered a crash, because I think people are kind of expecting this and investors are ready for it to happen. Meaning most investors are pretty smart, so they know if something runs by 60%, coming 20% back down isn't a huge deal and just creates another buying opportunity for people. I think places like Austin, California, and Florida will be hit the hardest with the crash or the at least decline. Other places in the country, I expect a 5 to 10% fall. Unless you're in a rural area, then it's going to be kind of based off of local laws and just migration movements in general, to where I could see places even increasing in value if they're a rural area or the Midwest. But these are just my 2 cents, and I am no financial advisor. But if you found this video helpful in any way, please like it. It really helps me out a lot. And comment if you have any other ideas for videos. See you in the next one.